up, everybody? Welcome aboard. It is Trading with Bubba, and yesterday's buyers bring in today's sellers, and markets are under some heavy pressure in front of Jobs Friday tomorrow. I would suspect that there's not going to be any real dramatic movement today. I think you're probably looking at a pretty dull market, although it is under some heavy pressure. But don't let the 190 points in the Nasdaq confuse you, okay? Because at the end of the day, it's 1%. Okay, and if you had a $100 stock at 1%, you wouldn't even think twice about it. So don't get crazy. Don't worry about these numbers. The numbers are just bigger. When I started trading, the Dow was 800. Okay, now it's 35,000. In the meantime, as we take a look at the markets and see what's going on, the S&P is right at trying to break out again. See, as we've talked about these phases, and we've marked these in every time we've talked about these things. And we told you also on Tuesday that we expected a rally. So we got the rally, so now the sellers are back. But really, as I said earlier, tomorrow is really what this is all about, okay? There might be some early information out because with the jobless claims and with the formulas known to everybody, a lot of the big firms are already taking their stand, which is why no matter what the number is, you might see an opposite reaction, because a lot of stuff could be being priced in already today. But watch the S&P. I think the key to watching the S&P is around 4290. Below it, I'd be a seller. Above it, I'd probably have to look to potentially be a buyer. But that's what I'd be looking in there. And the NASDAQ is right dead solid and still in consolidation. Could not break out. Okay, could not do much of anything. Okay, and that's something that you want to remember. Okay, is that it's really just churning between 14.6 and 15,000. Okay, in between, there's not much to do unless you want to try to sell the top of the range and buy the bottom of the range. The Russell, Romeo Tango Yankee, breaking down. And here we are at another key spot in the Russell. Now, for those of you who like chart patterns, I don't use them. I use the phases of the market, which I taught you. But you see these lines here? This is a head and shoulders right here, okay? Left shoulder, head, right shoulder. This was the neckline, okay? And the neckline has been broken, which means it's going lower. Well, no kidding. It's going lower. I think you might see a little bit of a bounce off of here, but once we break through here, it could go straight down, and I think that's probably the direction we're headed in the Dow. Yankee Michael, again, it is already broken down. All right, so again, now we've got some resistance. Let's say about 360 to 400, and your support right now would be probably 33,000. Okay. Now again, personally, I expect these to all break dramatically lower. I don't care what the jobs number is tomorrow. I don't care what they tell me, because remember, the numbers that they give you tomorrow are really worthless, because they're going to be revised. If you really want to understand what's going on, as you hear them brag about how good the jobs number are, keep this in mind, that this year, calendar year 2023, we have lost 514,000 jobs. Okay, so no matter how good the numbers are, the revisions are the real numbers to watch, but nobody cares. Nobody cares that the real thing you should be watching is the U6, which is 6 months versus 3 months. But again, the government, for years has used this U3 and whatever. I'm not going to argue with them, but the facts are the facts. I think one big important thing to look at as well is the inversion of the yield curve. As it continues, as short-term rates continue to jump higher. And as you take a look, let me go back to the charts here, hold on. And we go back and take a look at the 10-year, okay? Now, the future is a little bit higher today, but look at this. The 10-year is now getting closer to 5%. I think before it peaks, it'll probably be at 6%, okay? And again, what does that mean to you? Well, it means a slower economy, slower spending. And the 30-year is actually, although going down, it's all equal to the 10-year. So when you think about the interest rate, okay, think about it from this perspective. I have to pay as much to borrow money or more on a short-term loan than I have to pay on a loan for 30 years. Okay, 2-year notes are over 5%. 30 years are under 5%. So I've got to pay more money to borrow money in the short term, okay, which is known as the yield curve. Let me go back here for one more second. Here, the yield curve is supposed to go like this, okay. Every period out, you should pay a little bit more money to carry that debt longer, okay. But the yield curve is going like this. That's called an inversion of the yield curve, okay. So when the yield curve inverts, okay, it's very bearish for the economy. And of course, the Federal Reserve continues to feed you bearish information because they have not done their overall job. They've done a horrible job trying to manage this, and they've tried to intervene and control the inflation that was created by the cost of oil. You can take 100% of the reason that we're in such high inflationary times and directly correlate it to the price of oil, okay? Because if you understand that crude oil is 80% of everything that you do in life has something to do with crude oil, whether you're driving to work, whether you're buying food at the grocery store, you buy a bottle of water, it takes money, it takes fuel to deliver it to the store, and it also takes oil to make that plastic that creates the bottle, okay? So, we can talk all we want about climate change. We can talk all we want about all the other things that are going on. But at the end of the day, the carbon footprint here is not changed, okay? Because as long as you have China and India, which represent 40% of the world, they're never going to stop burning coal. So you're not going to be able to change the carbon footprint much. But at what price do we want to destruct this country? Because the inflation is far higher than the 3.7% that you saw on your last CPI number. Your inflation is probably closer to 20%. And just take, as I said, look at the cost of fuel. Now you've got your farming community, which is getting hammered because their costs are going so much higher. What they call the input costs, or the cost of plant, from their lending rate or their borrowing rate, has gone up through the sky. Their fuel costs, which they use a lot of fuel to produce, and the retail store is much more expensive. The divergence in price between wholesale and retail is ridiculous. Now, many farmers will produce enough product to overcome the low price, but what about the ones that won't? So what you're seeing is a lot of destruction, okay, and you're seeing it because of the high cost of oil. Now, we've seen over the last couple of days, oil has come down a little bit, but I think when you look at it in reality, I mean, yeah, it's broken hard the last few days, but look at how much higher we are. Look at how much you're paying at the pump. Okay, if you're paying, we're depending on where you live, anywhere between $4 and $6 a gallon. That's a big chunk out of the average American's check. Okay, so and I would suspect that there's a greater chance to see 100 than there is to see 75, and I think you're going to continue to go higher here as well. As you look at some of the stocks today, because you're seeing some of them are saying, or at least holding, but like Apple is stuck in consolidation, 170 to 175. Coin is stuck in consolidation, 70 to 80. Meta stuck in consolidation, 290 to 310. Now, part of the reasoning for some of these things is you still have the last minute lagger buyers trying to come in here and buy. This is typically the end. Okay, I would expect to see markets really start to crack out here now. Again, nothing today because we have to worry about tomorrow. Okay, but overall, I think we're headed south. It would not surprise me if the Dow and the S&P actually close flat to lower on the year, and they are both up between 8 and 10% for the year. The Nasdaq is up far. I think it has too far of a lead to come back to break even. But in the meantime, you look at a lot of these stocks, you see them stuck in a consolidation pattern. Why? Because we've got earnings season coming up. Okay, so now we're going to get some more information. Okay, based on earnings. So it's natural to see things stuck more in a consolidating range. I think the best short-term play, and even if you were going to play it going into, this is a play I would make going into tomorrow's jobs number. I'd be looking to get long gold in some way, shape, or form, because gold has been so dramatically oversold. If we look at the future first, because that's what everything is based on. Okay. Okay, so gold's been down 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row, and 10 out of 11. There's a high probability of a bounce. And certainly we know that gold is going to be very active on the jobs number, if not before. So I think what you want to look at here, again, I'm not encouraging you or telling you to do anything. I'm telling you something that if you're looking for a place, for a play or something to do, try to build an inexpensive position, okay, in these markets that would give you limited risk but unlimited reward should it come up, or limited risk, limited reward, but the reward big enough. And I mean, something that I might look at, I'd be looking more probably at like a stock like Nugget, okay, because again, that's a leverage ETF, which you really can't trade long term because you'll get killed because of the way they rip you off on these leverage products. But for a short term trade, and even like for tomorrow, right? The stock is trading at $25 approximately. And if you want to take a chance and risk $50 to make 100 to 200 to 300, it might be a good play. And again, I'm not making any recommendations, but there's ways to create different types of trades. And certainly with a day to go, and you're really playing for that announcement tomorrow, if you're going to make that play, I think it's a better play. Okay. Now, again, there's other ways to play this. You want to take out some of the risk. You could sell. You could maybe sell a put spread in Nugget or in anything, but I may get Nugget up. So if I sell, I don't want to sell caliber. I want to sell a vertical. Oh, there we go. Okay, so let's say I would sell the 28.50 and buy the 26. Okay, I'm getting a 240 credit approximately. I don't know that I could get that much credit. That's what it's showing. That would make my risk 10 cents. Okay, but I would have to get a solid rally, and I would not make one dime until it got past 26. It's trading at 25, so it would have to rally at least $1 to make money. But of course, at 10 cents risk, it may be worth the maybe worth the $10 again. Excuse me. There's no recommendation, but again, if you're looking for spot plays with very low risk and high probability, I think that's something that you can take a look at. And again, you can do it through, if you want to do, you could do it through GLD. If that made you more comfortable. Okay, GLD, you could look at the 169 calls, for example, are at 60 cents. So they're worth zero right now. Okay, because they have all extrinsic value, no intrinsic value. But if I bought these at 60 cents, okay, I would need a rally to 169.60 to break even. And if I got a big enough rally, I could get it. Now, again, the expectation of movement for tomorrow is only $1.60 in general. So if I get a $1.60 move, I could, if it's in my favor, I could make money. But it's $1.60 either way. Okay. But if I look at now the same type of situation here and sell a spread, okay, which is again just creating a synthetic long. Let's go to 170. And let's take this to 176. A $6 wide spread. So here I could take 19 cents or $19 worth of risk. Okay. If it goes straight up, this continues to go down. I can make a maximum of $5.81. Now, I don't think that it's going to have that big of a move. I think it's hard for us to move that far, but you never know. But again, anytime you're looking at a trade, your number one thing in your mind is, what's my risk? What's my reward? What's my expectation of success? Okay. And your risk should never be more than your reward. Okay. You're making a mistake if you're exposing yourself, especially into a what could be a wild number. Okay. I think that you have to remember, okay, that the market knows what it's doing. It's always right because it's an inanimate object. Okay. So we have to try to set ourselves up to be best into that market and make the trade based on what our expectations are, based on what we see in the chart. So if I go back and I say, well, geez, gold is so oversold, and of course it is. It's been oversold for 8 days. we know there's a bounce coming. Now, does it have to be tomorrow? No, it doesn't have to be tomorrow. It could be anytime. Okay, I'm sorry. Let me show you this. I meant to show you this, but here you go. Okay, this has been oversold based on the Bollinger Bands for 9 days. Okay, so if you're looking at it again, so there's a higher probability of what we would call some mean reversion versus a continuation of the selling. Now overall, it may continue to go a lot lower. That we don't have an answer for. But what we do have an idea for is that markets that get too far oversold or overbought tend to have what they call mean reversion. Okay. And, mean reversion would mean that it would have either a sell-off from the tops or a rally from the bottoms. And in our case here, there'd be some sort of a rally. And it wouldn't be a surprise if we got a rally. And again, you have a good faith belief that they've sold off gold, for example, so hard going into the news tomorrow that it might very well pop on that, because maybe everybody's priced in such negative news for gold that no matter what the news is, it'll turn around. And I think one thing you have to remember when you're playing with numbers, markets give you expectations of what they're going to do, okay, and not directionally necessarily. Although the market footprint will tell you this isn't a downtrend, but what you want to look at is if you don't get a number that says what the expectation of movement is for tomorrow or any period of time, you can just look at the money straddle, okay, and that will give you an idea of how much the market is expecting movement, okay. So this is expecting about $1. It's 145 times 1.07. So it's about $1.60 is about the expectation, which we already know because we saw it. But if you don't have that, this will tell you what the expectation of movement is. So if you look at this, then you look at the chart and you go, which way do we have a greater probability of moving based on where we are today? Not 6 weeks from now, but tomorrow. Today and tomorrow, for example. Which way do I have a better chance to move? Okay. And in my eyes, when I look at this chart, the higher probability is that the markets are going to go higher first from here. They don't have to go dramatically higher. Remember, I only need a couple of dollar rally here. It's not like I need a monster. And the mean, okay, which is here, the mean is at 175.50. We're $7 from the mean. That's 2 standard deviations away. If I get a 1 standard deviation move, I make a couple of $100. Okay. And if I take 16 cents risk or 19 cents risk or 20 cents risk, what's wrong with that? I'm risking 20 cents to have a chance to make as much as $500. Okay. But also, if I get a 1 standard deviation move, which is not that hard, especially on a jobs number, I can still make a couple of hundred. So a 10-to-1 potential shot is always something to think about. Now, again, just because I'm telling you that those are potential trades, you have to have a good faith belief based on what you're seeing in the market and understand the market itself as well, the charts, right? Because again, there's a lot of 20-to-1 shots out there, but do I have a good faith belief in my model that says that it could happen, realistically happen? And again, when you look at something that's been oversold for such a long period of time, I will make this statement to you here. Okay. By Tuesday, when we come back, GLD will have traded as high as or higher than 171 by the time we come back on Tuesday. Now, again, doesn't mean it'll be tomorrow, but there'll be a rally. Okay? It could be today. So again, I don't know when it's going to happen. If it comes Monday and I had my position on for tomorrow, which is the positions I showed you, I don't make any money. Okay. I sit there and wonder what happened. So, but again, we look at probability. If you listen to the updates I do every day for a minute, yesterday on the update, I said, look to be a buyer of the SPY, Sierra Papa Yankee. Okay. Now, again, I'm not claiming to be a brilliant genius of the markets. I'm telling you, when we look at things, I did the update at right about this time here. Where we at? Right about here. Okay, right about here. Okay. And look what happened. The markets went straight up. Okay. And again, That's not always going to happen. Oh, thank you. Okay. That's not always going to happen. Okay. But what's going to happen is, again, you're trying to find, your job is to try to find the highest amount of probability. Okay. And that becomes always your goal, and your objective is to locate the probability models. Okay. And if I can do that, so here, not only have I been oversold in gold, but I'm starting to kind of curl up here, even though it's going lower, it's still it's trying to, like, what we'll call round out the bottom. Now, again, does that mean that I'm going to be right? No, it doesn't mean I'm going to be right. But I think there's a pretty high probability that we get a pretty good rally. And in my mind, it wouldn't surprise me at all if by Tuesday, when we come back, gold itself has traded up to about 1860, 1870. Now, again, these are probability shots. These are not guaranteed. There's nothing in the markets. There's nothing ever guaranteed. Okay, all these are probability shots. Okay, so when markets are tougher to trade, I'm trying to find setups that have a high probability of success, but that have very minimal risk, so that if I am wrong, I don't have to worry about it. It doesn't become an issue if I happen to be wrong. Okay. And I think that's something that we have to look at as well. Okay. Is, again, we're all we're trying to do here is be in the best position. Okay. Whether if you're a game player, there's games of probability: gin, backgammon, bridge, and poker. Those are 4 games that are all based on mathematics. Okay. If you're the better player, you're going to win. Now, you're not going to win every time you play, but you're going to win over time. And remember, trading is a grind over time. You have to learn about what's called delayed gratification, because I can't tell you that I'm going to make money today. Okay. I can tell you that in 45 years, I've grounded out on an annual basis, but I can't tell you what's going to happen in the next couple of days. I can tell you in the next few minutes, and let's just see if there's anything to trade while we're hanging out here together. So we made our crude trade the other day worked out to be pretty good. Okay, didn't get stopped out. We had a great stop in, and of course, it worked out to be a pretty good trade. But let's just see if we got anything going on. As it turns out, there's a potential here of another trade in crude, and obviously it's kind of scary to jump in a trade that's a market that's going straight down. Oh, thanks, Maxie or Luis. But in the meantime, maybe we'll take a shot at it. Again, I'm not opposed to ever taking what I consider high probability, because I do understand and know where I'm going to have my risk is at. Okay, so I already know how much risk I'm willing to take, and how much reward I have no idea. Okay, so I'm going to flip over to my little 1-minute chart, and I'm looking for a reason to buy. But again, all we're looking for is probability. Okay, that's the whole model. Poker. If you play poker, if you're a good player, like I played yesterday, I played in the tournament yesterday. Okay, I got knocked out of the tournament, which happens. Listen, I got knocked out with kings against aces. Okay, but at the end of the day, okay, I went to play live and I won all my money back. All right, but again, it's a straight probability model. Okay, just like backgammon is. It's all about the math. It has nothing to do with my opinion. Okay, and now we're getting a little bit of a run up here, and look at this. So now, crude would be a potential trade, but now I have to be careful. Okay, I got to watch what we call the blowback here. All right, so I'm going to go ahead and take this trade here. Okay. Now, I don't know if we'll be together when it's all done. I'm going to put my stop in right now at 82.28. Okay, 82.28. Okay, I've already got a nice winner. I could actually cash it out right now, but I'm not going to do so. I'm going to let it trade for a little bit. Okay. Okay. So, bottom. I took myself out of here. Anyways, I'm having a tough time with all the controls and all the trading going on. But in the meantime, we've got a crude starting to run now, and I may get taken out. okay, by the market. Okay, if the market goes up fast enough and gives me a reversal, I might reverse that same trade. But right now we got a little bit of a profit. Okay, but what I'm trying to explain to y'all here is it's all about what you can see in the chart. It's all about the numbers. It's got nothing to do with the news. It's got nothing to do with the crap you hear everywhere, you read. That stuff's already priced into the market. The markets already know what the news is. The only news that ever affects the market, okay, is what is known as a fundamental news bomb, which nobody can account for. Okay, so unless there's something crazy that happens, but if it's anything that has reports that go before it, it's never a surprise. There's nothing any big, right? So keep that in your mind, that when you hear news, think of that you're like the 1 millionth person to get that news item. Because if you try to trade off it, we have a saying here: trade the news, you lose. Okay. So again, as we remember here, markets should be relatively, they're pretty choppy right now, but they are running all over the place. Okay. They're having some big swings back and forth. And as I said, it wouldn't surprise me as if by tomorrow, okay, or by the end of today, that we were somewhere near the flat line, believe it or not, because again, going into the number tomorrow, there's a lot of things going on. So we'll see how it plays out. We'll see how it works out. But in the meantime, unless you're an experienced trader and you're willing to take extra risk, either use very low risk positions as I showed you or shared with you today, or wait to react to the number tomorrow after it comes out, which is always a good idea, is to react after the number comes out. All right, kids, enjoy it. Have a great day. We'll see you back here on Tuesday. Actually, I'll do an update tomorrow, but the full show will be back on Tuesday. Have a great day. Have a great weekend. And if you're a football person, take the Washington Commanders tonight. Adios.